Welcome, everyone, and thanks for joining. I'm your host for today's meetup. And today, our topic is being competitive in the competitive market. And also, we're going to be learning about some tips and tricks about capital raising. My name is Loomba. I'm a founder and a CEO of Loomba Investment Group. I'm in the commercial real estate investing space with special focus on multifamily investing. I love to help and educate people on real estate investing and passive income, or some call it mailbox money, maybe. I host educational webinars or meetups every other week on Fridays. I try to bring some interesting topics on real estate multifamily investing as well as on syndication. And I try to bring some great guests who are the SMEs in their field. I always look for investor partners and love to build strong connections. Please feel free to reach out and connect with me on social media, LinkedIn, Facebook, if we are not already connected. Or you can go to my website, loombainvest.com, and you're welcome to download my book, 7 Reasons Why Syndication Helps You Build Long-Term Wealth. And also, you can download my podcast, Wife. That's a great podcast where we try to bring the success stories of people where they start with the humble beginning and then they just have this great successful trajectory. So please download our podcast. I'll put the link in the chat and try to tune in and give us some ratings there. And before we get started, I would like to go through a small little disclaimer. If I can share my screen. This presentation is strictly for educational purposes only and should not be considered as a legal, accounting, or investment advice. This presentation does not represent an offer to sell or a solicitation on offer to purchase an investment or security. The strategies mentioned in this presentation may not be applicable to everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties, expressed or implied, as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and/or errors or omissions thereof. Please consult with your own attorney, financial advisors, CPA for any legal matters or any investments or any specific tax situations. Once again, this is strictly knowledge sharing for educational purposes only. Today's guest is Chris Salerno, one of the highly successful person in the real estate industry. He has successfully transacted more than 40 million in real estate volume and helped lead the #1 real estate team in Carolinas to produce more than 140 million in annual sales prior to creating QC Capital. That's his company. He has been named to Charlotte's 30 Under 30, Elite 50 Entrepreneurs and 30 Under 30 Entrepreneurs. And he has also been nominated for Forbes 30 Under 30 in 2018 and 2020. Chris is a powerhouse of knowledge when it comes to real estate. And today he's with us to share his knowledge about how to be competitive in the competitive markets. And he will also share some tips and tricks for raising capital for multifamily deals. So welcome, Chris. The stage is yours.
Thank you. Thank you so much, Pinky, for having me. Very excited to be here.
I would like you to give us a little bit background for yourself, who you are and where you are, and how did you get here before we dig into our today's topic.
Yeah, very much so. So thank you everyone for attending. Very excited to be here. So my name, like Pinky said, is Chris Salerno. I reside here in Charlotte, North Carolina. I've been here over 14 years, originally from South Florida. I started out in the residential industry, brokeraging residential real estate. From there, I also had fix and flips, single family rentals, and my main business was brokeraging real estate. Very quickly became the top agent with Keller Williams in Charlotte within the first year. I then started to grow a team, which they call that in Keller Williams, a company. And from there, I merged it with the #1 company in the Carolinas. We're also #4 in the world by unit count. When I did the merger, I was always intrigued with business and still am to this day. I love to dive deep into it on why large companies make large business decisions. For example, Blackstone just bought affordable housing, around 5.1 billion. So I want to know why. What was their thought process behind that? And so when I did the merger, I found so many cracks in the company's foundation. So I started putting my knowledge into place, and I was able to make them 46% profitable in about a year and a half compared to their 3 years of being stagnant, no growth. After doing that, I just felt like I hit a ceiling. I felt like I was at that hustle a day after day, and I really wanted to build the wealth and wanted to grow a large company. So from there, I started educating myself, just like you guys are doing right now, listening to podcasts, getting on Zoom videos, going on YouTube, reading books, going to networking events, and started educating myself about other types of real estate type of investing. And so I studied the '08 market, and I realized multifamily is the strongest asset class that recovered the quickest, economies of scale. From there, I actually, a lot of people don't know this, but you can go on to the SEC website. So if you go to sec.gov, you can pull up companies that have registered as a 506c public offering. You can pull up their PPMs. So at the time, Grant Cardone was a big name. He still is, but at the time he was growing. So I went on the SEC website and I printed out over 300 pages of his PPM and I started reading it. Now, I would lie to you if I told you I fell asleep, or I didn't fall asleep, excuse me, because I did. PPMs are not fun to read, but you gain a lot of knowledge from them. So I highly recommend diving into a PPM, reading it word for word. You will gain a lot of knowledge. From that, I knew that I wanted to be in the multifamily space. I wanted the economies of scale. I wanted the recession-resistant type of asset of investing, and I also wanted to have that as the foundation of growing a large company. From there, I did what you guys are doing, podcast, books, YouTube videos. I then found a coach and a mentor. Didn't know he coached and mentored, but I found him, and we're one-on-one. His name is Joe Fairless. He's a personal friend of mine and a coach and a mentor. And then I very quickly scaled the company. Within 7 months, acquired a little over 40 million, 364 units. From there, I knew I needed to build out the foundation of the company with the right key employees for the growth I wanted to have. And so it took around 8 months to hire around 5 key individuals to ensure that on that next acquisition, we can be extremely detailed and we have our strategy in place to execute. And this team would be able to execute long term for the growth. After doing so, right then COVID hit, put a damper on the deal flow here that we saw in the Carolinas for about 2 to 3 months. That gave me extra time to go deeper into our strategies with our team. And then we went back on acquisition mode once we started seeing the deal flow pick up. We were able to acquire a deal fourth quarter of last year, raising roughly $7 million through the pandemic, the holiday election, or excuse me, the election and the holidays. So very difficult times to raise capital, but we were able to successfully get it done, and we're very happy on how that property is performing. So that's a little bit, I mean, that's from start to finish, how I got into the space, why I got into the space, and some of the things I did early on to get to where I'm at today.
Great. So today our topic is about how to be competitive in a competitive market. So I'm going to ask you the first question that I wanted to start with is, what constitute a competitive market?
Yeah, I think really if you're focusing anything in the Southeast is a very competitive market. I live here in Charlotte, North Carolina. I'm sure if you guys are very active in the multifamily space, you guys know the Carolinas are a very hot topic right now on all the rankings. Any article that comes out, either Raleigh or Charlotte is in top 5, top 7 markets to invest in and markets to look for. Great thing is a very low cost of living. They have a lot of population growth, and that is also fueled by the jobs that are moving here due to the low cost of living and the tax advantages. So we're seeing here in the Carolinas, the large cities that are getting filled with large employers. We're seeing the population growth just be unbelievable. And when that happens, a lot of people are paying more rent, which makes this market an extremely competitive market as more and more people, more and more companies, more and more institutions want to get involved because they see the long-term growth trajectory that these cities are having. So the job and the population is really fueling the competitiveness when it comes to the private equity getting into these markets and buying these apartment complexes.
Do you need to have the understanding about the market data related to geography as well? And if yes, how can that affect the investment potential? If you
No,
look.
very much so. Very much so. I think it's very important. That's one thing we do, even in our backyard when we're looking in Charlotte, when we're looking in the Carolinas, when we start, we also look in Atlanta and Florida markets as well. And geography is extremely important because there's certain parts here in Charlotte that I will personally not invest in. I know other groups that personally bought assets in those geographic locations of Charlotte, which in my opinion are going to take some time, anywhere from 6 to 10 years to even start to see some change. And the rental premiums that they were projecting, I just did not see those. And the team did not see those as well. So it's very important to go into detail on the market. The one thing I stress about to our team and the director of acquisitions is that we need to go into detail, very strong into detail. We were looking at a beautiful asset in Charleston, South Carolina. Numbers looked great. Everything looked good, but something told me something was off. So I asked them multiple times, have you checked the property? Have you checked our criteria? We have a very strict underwriting criteria that the team has to check all of the boxes, and they have to review certain type of documents before it's presented to me, before I take a deeper dive into it. And some of those boxes were missed. And I knew that by reading over the OM. Come to find out, 50% of the property is built in 1972. Well, that's too old for us. We don't focus on assets normally built prior to 2000. And so I caught that. I brought it back to the team. I said, we were just about to submit an LOI, but we missed this, and this cannot happen again. And we passed on the deal. We were in best and actually, no, excuse me, we were actually in best and final. And we passed on the deal because of that reason. So I make sure our team is held accountable, and they stay very strict to the criteria, but they have to go deep in the geographic location in our very strict criteria that we have when analyzing these deals.
How do you get deals in so competitive market? And there's so multiple players, it's not even just you and me. There's like so many people out there looking for the same thing, and it's so competitive, everything. How do you make your space?
So the great question. It's extremely competitive. We get beat out by a lot of institutions that are just paying 20,000 per unit more than us right now, and that just blows our mind. But it goes back to the old saying, and a lot of people will probably not like hearing this, but relationships. It's you have to have very strong relationships with these brokers. We're in best and final in a portfolio here in the Carolinas. And the brokers I have very good relationships with the brokers that we go out to dinner, we go golfing together, we go to lunch together. They know my son. They ask how he's doing when we talk on the phone, and we submitted on the portfolio, and he said, you guys are in the lead. You guys are in the lead about 5,000 per unit higher. Your terms look great. So stay there. We'll let you know if anything changes. So it really comes down to the brokers and building very deep relationships with the brokers to be competitive on the forefront. There's multiple hurdles that you have to cross, not only leading up to submitting an LOI, but during the LOI, getting an LOI accepted, the PSA, and then still going all the way to the finish line to close the property. And then you're not done there, because now you have to execute your business strategy for that property so you can exit the deal down the road. So really the main thing to get a deal, in my opinion, is really having very strong relationships with the broker. That helps tremendously. And also having relationships with other owners that has transacted. If you have not transacted with that seller that you're about to transact with, if you've done a transaction before, see if those owners know each other and get them to give you a referral. If you've done a transaction with another broker, get that broker to call the broker or even the owner and have them have a conversation on that. Yes, you can execute as a company. They've worked with you before and it was a very smooth transaction. We've pulled all of those levers because you need to in this competitive market.
Building a relationship is really good. I think this is our relationships game, whether it's the investor relations or the broker relations. But the question that comes to my mind, how can you trust a broker that he's going to bring you a good deal, or all the deals are presented you are good, right? How can you differentiate, or how can you figure out like kind of a litmus test that you can walk us through?
Yeah, you really can't trust a broker, to be honest with you. And you got to you definitely have to do your own due diligence. When brokers email me or call me, or for example, that broker, I mean, I shoot it straight to them. I don't beat around the bush, and I tell it how it is. And so you really have to build deep relationships with them to get on that trust level. I think, when our family starts to hang out, there's a certain type of trust level relationship that you have, which is great. But as submitting the LOI, they can only do so much by talking you up as a company to the seller. It comes down to the terms of the LOI. It comes down to how much hard money you have. For example, if you looked in 2015, 2016, people were rarely putting hard money down. And those individuals that put 100,000, 200,000 hard, they were winning deals. And then all of a sudden, people went from 3 to 400,000, 5 to 600,000. Now, what I'm seeing in the Carolinas, people are placing anywhere from $1 million to $2 million hard day one going into a deal. Now, they're going to beat you out all day because they have the ability to. That can be a high risk. It depends on their due diligence prior to LOI. But that's what we're doing. We're placing a large amount of hard money down day one to also get our foot in the door and to have a very competitive LOI in front of the owner.
So, but what is the comfort level with the hard money? What if the deal didn't work out? Because I know recently I've seen one deal that I was working on, money went hard and then deal fell through. So what is your take on that?
Well, my take on a deal falling through, I mean, it definitely comes down, to the deal itself. The newer type of vintage, I would definitely place 1.5 to 2 million hard any day because it's a newer type of product. When you start to get into the 1960s, 70s, 80s, those are extremely risky type of products. Even if you do enough due diligence up front, extremely risky type. So it comes down to your comfort level and the risk versus reward that you have to weigh out when you're looking to acquire these properties. With these newer assets that we are looking at, I'm okay with putting $1 million like I said, 1.5, $1 million, 2 million down hard day one because of the newer type of product, where they were built. I have very strong confidence in that due diligence phase that everything will not necessarily go smoothly, but have a chance that it will go a lot smoother than buying a 1980s or 70s type of product.
Wow, you said a very good thing, risk versus reward. So I wanted to ask you this question. How do you determine your risk versus reward tolerance so that you can align your real estate investments accordingly? So it's like less room for error?
Yeah, no, that's a great question. I weigh risk versus reward, and a lot of my business partners and other different type of businesses that I have, they hear me say that all the time when we're in a meeting. What's my risk? What's my reward? And I think of that when they tell me things. I analyze, well, what's my risk? What's my reward? When it comes to rents and when it comes to the projection of properties, I'm seeing a lot of these groups being extremely aggressive. Some groups are underwriting the same cap rate going, or their exit cap is their same entry cap. Which can be extremely aggressive. And then also on top of this, I'm seeing groups underwrite anywhere from 8 to 12% in year one economic rent growth. Yes, that looks great right now because inflation is rising substantially over 5%, which is a record. And if you look back at 2008, inflation was over 5%. And so where it's very close to history repeating itself based off the chart of back in 08. So I'm seeing a lot of groups underwrite to that 8 to 12% economic rent growth just in year one based off of inflation, which I think can be extremely risky due to what happens when everything decides to calm down and we're not achieving 8 to 12% anymore every single year in rent growth because inflation, and we're going back to 3 to 5%. Your numbers are going to be drastically changed. And you're going to have a conversation with your business partners, with your investors that have partnered in those deals with you about those numbers changing. So I think a lot of these groups are seeing that right now, and they may not be thinking what's going to happen in a year to 3 years from now when this inflation slows down on these properties, and they're underwriting them based off of these astronomical amount of numbers and percentages, which is just boosting their returns to make the deal look good. So it's very careful to, if you're a passive investor, or even if you're analyzing your own deals or analyzing someone else's deals, to see what are their rent growth compared to the market, what are their rental premiums compared to their competitors, how are those units, what type of units are those, what do they offer when it comes to properties. It's very important to scrub and go into detail on everything when it comes down to the numbers and the projections.
So is there any rule of thumb that you follow for the entry cap or exit cap? Like you were saying, these days, mostly people are underwriting, same entry as well as exit cap.
Yeah, so when it comes to it definitely depends on deal specifics and location specifics for us. We'll underwrite anywhere from 5 to 10% basis points per year, 5% being aggressive. Will we go a little lower? There's a possibility. It depends on the market. If we're looking currently at a asset in the heart of Charlotte, which is a phenomenal property, phenomenal location, and I think the growth of that property in that location is just going to rise substantially. So I would feel comfortable underwriting at a 5 basis points per year or a little less due to that market because of my market knowledge. And that's why it's key to go into detail about market knowledge and geographic location that you're investing in. So yeah, it's definitely important to analyze that. But anywhere from 5 to 10 basis points per year. I know some groups that do more than 10 basis points per year. They're not really winning any deals at all, and they're substantially below asking price or pricing guidance when it comes to LOI. So you have to find that perfect medium and that basis to level it out. But it definitely depends on the location of that property and the type of asset that you're looking to invest in.
I know you look at the market cap rate, there's a bunch of other things indicated that you look at it before you decide it's a good deal or no. But given the market that is so competitive, so we don't even know the things are overpriced or no, which they are actually, So how do you determine that?
Yeah, so it's when it comes to the market and determining really the property itself, it's extremely competitive, and those groups are underwriting extremely aggressively. I think you really have to go deep with the property of itself, and you really have to make that decision based off the numbers in the area. For example, I was touring an asset, and they said that the broker, we lost out on another deal to to a large institution. And I said, what did that deal end up trading for? And he said it ended up trading for high 2 cap. And I said, are you serious? We're already in the 2s in the Carolinas. And he's like, yeah, it came out to like 2.85. I said, that's unbelievable. So we're seeing right now in the Carolinas low 3 caps, and a lot of people are justifying it based off of inflation, based off of their pro forma, and what they think they can get in the next 3 to 5 years. So it's very important to analyze that entry cap. We don't really stay and have a large focus on the entry cap. But we have a large focus on our business strategy with the property and the location and where and what type of asset that property is to really determine our returns when it comes to it.
How did you make your space in this competitive market? I know there's a lot of competition, but what happened is some investors are doing better than others. So they have created some kind of competitive advantage for themselves. Did you do something like that? And what is it? Can you share that with us? That secret success?
Yeah, I mean, being competitive and growing a company, I think it's very key to stay very strict to your values and your strategy. For example, when I have investor calls and investor talks, we stay very strict. Some investors I talk to say, I want high teens returns. And I said, well, I would love high teens returns, but that's not what I'm seeing right now in the market. So we may not be a good fit for a partnership. Because I'm not going to tell you this property can get a high teens returns when it can't produce it. And I'm seeing some other groups I'm seeing some of their numbers for their offerings are just so large and so wide. I'm like, I don't understand how you can achieve those numbers. And so I think one thing that to have us be a strong company, both with the investor side and with staying competitive, is that we are very strict to our values. We're very strict to our strategy, and our investor base and our partners realize that we're not going out there and we're not buying one deal every month or one deal every quarter just to make the numbers work. We're actually going really deep into our criteria, and we're passing on deals. We're okay walking away from deals because they don't make sense. And I think they like that a lot, and they have that confidence in us that we're not going out and buying all these deals like some of these groups are. We're actually staying very strict to our criteria and our strategy, and we're buying deals that actually make sense, not trying to fluff up the numbers so they look good so we can get an acquisition fee or make money off of a deal, or hope to make money off a deal when we exit. So I would say, just be very strict, stay very, have a clean strategy. Don't go off your railroad track. Stay on it. Don't try to do multiple things at once. And when you talk to your investor partners, they will realize that, and they'll have that confidence in you, and they'll stay loyal to you. So when you get that next acquisition 3 months or 6 months down the road.
Interesting. Do you follow the economic cycles?
Yeah, I do follow economic cycles. I'm in a couple closed networking groups that we talk globally, what's going on economically, and also in the United States. And that's one thing I like to do right when I wake up in the morning, is I follow that very closely on what's going on in other countries, how it's impacting the United States. And I do think, we are seeing hyperinflation in the market. I'm seeing that more and more. I'm also seeing a lot of job shortage and labor shortage. And like I said, I read an article about a graph, and we're at over 5% right now inflation, and that's the same place we were at the middle of 2008. Over 5%. So who knows? Hopefully things correct itself in a positive manner. But you also have to prepare for the worst, and be very due diligent when you are underwriting these assets to not make a mistake in a year to 3 years down the road.
I should ask everybody else to chime in if anybody has any questions on the competitive markets or market trends before we change the subject to capital raising. Please chime in.
Yeah, so make sure you put your questions in the chat box. And while you do that, I want to touch on one thing: how crazy this market is in the Carolinas. Vinky and I are partners on a deal here in the Carolinas, and I got a text from the broker late last night, and he said, "Hey, how does 130 a door sound?" And I said, "Are you kidding me? It's only been 7 months since we own the property. You really think we can get 130 a door right now? We bought it for 95 a door 7 months ago." Mm-hmm. And he said, yeah, he said he just sold a property about a couple miles down the street for 160 a door, newer type of product, but he said about 160 a door. And he's like, this market is just unbelievable. So it blows my mind on just in 7 months, we went up 35,000 per door with doing nothing except painting the exterior and landscaping. So that right there, I'm seeing, and I think that's going to go on for a little longer. But how long can that go on with that hyperinflation? We're gonna see and see how it impacts not only real estate, multifamily, but how it impacts other the whole financial market as a whole.
I don't know. I have a quick question to kind of follow up on that. It's around like who's getting stuck like with the hot potato. Like at what point do you say, we can't compete here. We have to rethink our strategy. We have to perhaps pull back a little bit, because like I said, if you guys entered, like you had a business plan in mind 7 months ago when you entered at 95 a door, and to get this offer now, and especially with institutional money coming in and just spending, I mean, they don't care, right? Like 2.5, 2.8.
Yeah.
Like at some point, like, I mean, it's great that you're already in, right? But for anyone who's right now trying to get in and it's as competitive as possible, it's kind of like, okay, when does this tip, right? And you don't want to be the one coming in and buying your place at 130 a door, and then the market turns in 6 months, and then your business plan is very difficult to achieve.
Correct. Yeah. So when is that turning point? That's why it stays, or it's important to stay in the market. It's important to stay on top of the market on a daily basis, studying the market trends, studying what's happening in the market that you're invested in and going to invest in. It's important to stay on that on a daily basis because you have a better idea on when you may feel that something is going to turn. The great thing is about multifamily is it's a necessity. People need shelter. It's not going away. You can't create Amazon to take shelter away. We will always need it for the rest of our lives. And that's why I got into multifamily, is that it's a necessity. We need it. It's not that we want it, we need it. And so even with everything that's going on, what happens? Our rents maybe have to change and go a little less. We maybe have to decrease rents. But when it comes to, in my opinion, the single family market, even though the single family market right now is astronomical for resale because of the new construction being extremely down over the past 5 decades, what happens when some of these people lose their jobs? They're going to go rent. So in the benefit of multifamily is the economies of scale. But it's always important to stay on top of the market to see, when that turning point and that ball starts to roll downhill, because you're going to have to change your business strategy, the way you market, and in the property itself.
Hey, Chris, I had a question since you focus on this quite a bit. What are your thoughts on, especially with inflation as high as it is, on interest rate increase? And I asked this more, a little bit longer term, 3 to 5 years, when people are so dependent on, refinances and stuff, to have, the returns paid out that they're expecting. Love to get your thoughts on that.
Yeah, no, I definitely think, the Fed said they're going to raise interest rates twice in the next 3 years. Who knows? We all know Uncle Sam and what they're doing. They're unpredictable. If they do, it's understandable. When Feds raise interest rates, well, let me say this. Right now, if you look at the finance market and the lending market, you're seeing that probably 98 to 99% of these loans are bridge loans. That's, if you talk to a broker, they have done all bridge loans in the past 8 months. Why? Because they're offering very competitive interest rates and they're offering a lot higher leverage. Well, who's losing out on the money that they're lending? Freddie and Fannie. The government has a certain amount of capital that they have to lend that year. So they have a certain amount of quota. Well, their LTV is a lot less. So they're only giving anywhere from 55 to 65%. In some cases, you may be able to get better, but that's what I'm seeing right now in the market. And so everybody's going to bridge. And interest rates are very low. When the Feds raise interest rates, that means the Feds feel that it's a great market. The market's thriving, so they can go ahead and raise interest rates. I think they're going to be extremely hesitant the way inflation is going right now at the moment on raising interest rates. Because if they raise interest rates, why we have this hyperinflation, I feel like that's going to be a downside for us. And that's when the ball is going to push and start rolling down the hill. So I think they're going to be extremely careful when they do that. But they're also realizing that they're losing a lot of money right now to private equity companies and these banks that are handing out these bridge loans because they're getting all the business. So there's going to have to be a happy median that they come up with to raise interest rates, and then also to give more leverage. But first, they're going to have to start with giving more leverage for Freddie and Fannie right now at the moment to see where things go in the next 1 to 3 years.
Yeah, no, absolutely. My concern comes a little bit more not where we are today, but where we might be, especially, if the 6 trillion plan goes through and there's more physical stimulus coming ahead. And, given that with the 4 trillion, we're already, at 5% inflation, right? So that's my concern, is more, again, longer term. And, some people get into deals where they're expecting to refi a few years down the road.
Yeah, I think you're going to see a lot of trouble with those groups, in my opinion, refinancing. Why? Because they're buying at top of the market right now, and they're going to try to refinance in 2 to 5 years. And I don't think I know the market's going to be strong. If you look at the historical 60 years, real estate has always been on an incline. But there has been dips, and I do feel that they're going to struggle with a refi. in certain circumstances where they may not be able to refi and pay all their investors out, or they may have to bring some money to the table to refi because everyone's getting a bridge loan. Right now, bridge loans are 2 years plus 2 extensions, or maybe 3 years plus 2 extensions. And so that when their loan comes due, they're going to have to refi. And a lot of them are getting over leveraged, and they're not going to be able to refi if we have this hyperinflation and if interest rates rise. The numbers are not going to make sense. So I think a lot of people are going to have to change their business strategy, and there's going to be a possibility that there may be properties and opportunities to take advantage of if this happens. It just all depends right now when it comes to inflation and rent increase growing. I did see, to touch on that point of the stimulus check, I did see that they passed another stimulus check, which in my opinion, I was shocked that they are coming up with another stimulus check. I don't think it's a good idea, and I hope that there's not another one coming.
I have a question. I mean, when you're talking about the bridge lenders, so bridge loan is usually 2 + 1 + 1, 4 years. So if you look at the economic cycles, because I was reading this the other day, there's some journal, and it shows kind of upward trend for the economic cycles for the next 4 years at least. Maybe if you can stretch, maybe it could be 5 years, but it's 4 years maybe. So you think, what if all these bridge lenders are giving this loan 2 + 2, 2 + 1 + 1, 4 years, or 5 years, maybe exactly. After 5 years, if it's a downward trend, so what's going to happen to all those people who are getting the bridge now? You think maybe they have the insight that, they might have studied the economic cycles too?
I'm sure they definitely study economic cycles. I mean, they have thousands of analysts studying, studying the trends and where things are going. With 5 years IO on a bridge loan, right now, I'm not hearing that. If you know of a broker that can do that, please let me know. We've been quoted 4 years IO, and we've been quoted 5 years IO when it comes to agency, but the numbers don't make sense when it comes with the proceeds. But I think, with those extensions are not guaranteed extensions. And they can call that loan when they want to. So you have to apply for those extensions. So I think it's very important to, if you're waiting out there or if you're analyzing it, I think it's very important to watch extremely closely, because with those groups that are doing it, they're not going to be able to refi. They're going to have to sell. And are they going to sell more than what they bought it for, or their projections that they're trying to hit? It's a crystal ball that we all wish we could have. But the more education, the more learning and studying we do on a daily basis helps mold that. So when we're going to acquire an asset in a market that we're focused on, helps mold it for our pro forma and our projections.
Anyone else has any question on the market? Jim might have something.
No, I excited to move on to his insights on raising capital. And,
Okay.
but I will say that, I listened to JP Conklin and his opinions a lot. He's very, very tied into interest rates. Believes that he believes that the feds are signaling that that they have no intention of raising rates for the near term, 2 years, and that they would love to be able to, but that they just don't see that happening in this environment. I will say that one thing that's very, very different from 2008 is that we've seen this, particularly this year, where in 2008 money just dried up. The bridge lenders stepped in when the government decided to pull back, and that's why 2021 has been as successful as it has been in multifamily, is because private equity stepped in and filled that gap when Fannie and Freddie stepped away. And I think we're in a different dynamic. We're in a place that I know I've never been in my 63 years. I've never seen a cycle last this long, but it's not unprecedented. Australia has seen a 20-year bull run, and Canada had a 15-year bull run. And so, can we do that? I don't know.
Maybe.
But fundamentally, Yeah, I hope you're right. I hope you're right.
So,
That bodes well for staying in
all of us.
and being in long term. So, yeah.
Yeah, and we're in my opinion one of the best investments because the economy is a scale and it's a necessity. So even if we have a huge market crash or a correction, I'm still going to be. I'm going to be happy because we're in one of the best investments in my opinion that you could be in for those times.
Yeah. To your point earlier, Chris, about being over leveraged, you just got to be able to hang on. I went through the 2008 crash and didn't lose anything because I was able to hang on. And as long, it didn't matter that my net worth was cut in half, actually cut it by 60%. Really didn't matter because the checks kept arriving every month. Mm-hmm. And it wasn't a reduced check. My personal, cost of living, style of living, whatever you want to call it, did not diminish. My rents did not go down, and so I didn't get hurt. Just if you're able to hang on, if you're have a good asset and it's performing well, and you're not over leveraged, then your business plan might have to change. Which business plan was ever executed to the T? You have to, in this business, be very, very flexible, pliable, and ready to pivot and have a different exit plan or a different business plan. And it needs to be reevaluated constantly. But we're in for the long term. I agree with you.
Well said.
So let's move on to capital raising. So can you share some tips with us or any tricks that work for you over the years?
I can. Yes, I can. And I do have only 13 more minutes. So just to let everybody know, 13 more minutes. I'm a hard stop at 7 o'clock Eastern. So capital raising, I love capital raising. It's exciting and fun to me. I think over the past the years, I've definitely done a lot of trial and error with different type of marketing, different type of strategies to raise capital. One thing I found extremely useful is I always search for a group of like-minded individuals, high net worth people that come together. And I knew I hear there's groups out there, and I knew that there's groups out there. And so I recently joined at the beginning of the year. I joined a couple groups that are accredited investors only type of groups. Within these groups, there's also different levels where you have to have a certain net worth. Your CPA has to sign a letter stating that you meet a certain requirement to join these group or to join this division within the group. And networking within that group helps tremendously. We're like fraternity brothers. We're always connected. We always talk business. We always go out and we have a good time. And I would say surround yourself and try to get into groups like that to help raise capital. Just in one of the groups, we split up and go into individuals groups. Us four, I raised about $1 million in less than 20 minutes. And so it's very valuable to be in these type of groups with like-minded individuals and with people who want to do business and they have large goals and they're striving to become better. So I would say surround yourself in those type of groups, find out how to get in them. It will be extremely helpful to raising capital instead of going out there and trying to get everyone and anybody. It's a very unique strategy because these groups are all high net worth individuals. So you are targeting accredited investors for your deal, and it makes it a lot easier than just going out trying to grab everybody from social media or meetup groups, conferences, you name it.
So how did you find these groups? Is there any criteria?
Yeah, so one of the groups, there's a criteria of you have to be an accredited investor. So you have to meet the guidelines of what an accredited investor is to just get into the group. One of the groups within that group is called the Champions Division. You have to have a minimum net worth of 10 million, and your CPA has to sign a letter stating that you meet those requirements. Thankfully, I was able to get in there, which is a great group of people. The way they think is just it will blow your mind. And I'm happy to be a part of it and do business with everyone who's in there. There's some other groups that you have to have a certain minimum liquidity of 10 million. Those are like the very high top of the line networking groups. I am not in that just yet, but I will join that group when the time is right. And there's other groups like YPO, which is a great group of executives that get together. And I think it really helps. You can even Google these. You can network with high net worth individuals, because a lot of them are in these certain type of groups that are only accredited, only high net worth individuals, and it's great to network amongst all of them and raise capital from them.
So if you go to a group which is not a real estate related group, like for example, you mentioned Champions Division. So I'm hoping, I'm just assuming they might not be 100% real estate, right? So if you go to some group like that, because every group high net worth, they charge you tons of money upfront. It's like minimum like $500 or $1,000 a month to join these kind of groups. So it's gonna take you time to foster relations or build the connections, So what is your strategy for that? How do you convince people, or how do you make those connections that they will invest with you? Because eventually it will pay off. But initially putting $1,000 a month to go to these kind of groups, sometimes it does not make sense to some of us.
No, that's a great question. And yeah, these groups are great groups to be a part of. I would say anywhere from 50 to 60% of the select individuals are in real estate. Majority of them, I would say 95% want to invest into real estate. So it's a great topic, easy topic to talk to them, to park capital for tax benefits. But what is key in understanding it is that they already have some level of trust for you, because in these groups, you can't just get in the group. You can't email them or go on their website and fill out an application and you get an email 2 days later saying, congratulations, you've been accepted. No, you have to have phone call interviews. You have to have your CPA write letters. You have to have documents that you have to submit. So there's a level of trust that's already there when you walk in that door at that networking event, because we've already been vetted. And so that helps tremendously. And then by the education that you have and the way you speak about investing into multifamily helps a lot, where they feel very comfortable with investing with you. So that's why it's great to join these private networking groups, because they already have that level of trust for you where they're willing to invest with you on the first, second time they meet you.
Do you use any marketing strategies?
Yep. We have a podcast called the Mindful Multifamily Show on all iTunes, Spotify. We have a YouTube channel that we pour out educational content, and we have the Mindful Multifamily Network, which is a Facebook group that everybody networks within. We use that to pour out education. And then we have some very unique marketing strategies that we are slowly implementing and testing that, from my knowledge, no one's doing in the space. But I've previously done it in a couple other companies, and it's been very successful. So we're testing that to see how well that comes across, and I'll be able to give more insight on that as I get more data back on the return of the investment from that type of marketing. But it's key, social media marketing, pouring out great content, educational content to help people understand that they can invest in these large deals too. That's one thing I wasn't aware of when I first got in or prior to getting in the space. I would look at these large apartment complexes and I would think, okay, a bank owns it. These large private equity companies own it. I did not know I could be a part of this. And so it's key helping individuals understand that they can be a part of it. And that's one reason why I decided to write a book to help people invest into large multifamily assets and build their wealth, and really generational wealth for their kids.
Great. So can you talk about the raising capital from the institutions as well, because I know you have tons of connections in that area too. So how did you make those connections, and how easily you raise capital from the institutions?
Yeah, institutions are a whole different world. Those are long-term relationships. I started building those relationships years ago, and it's just staying in contact with them. They have a lot of people that are coming across their desk, and it's being genuine, straight to the point, and staying in contact with them. Every deal we get, I send it to them, whether if they say yes, we want to invest, or no. I still send it to them because I want to stay top of mind with them. And then also when they go to conferences, if you're going to, like, for example, IMN, IMN is a great conference. I'll be in Atlanta speaking at that conference. A lot of institutional investors will be there. It's important to take them out to coffee, take them out to lunch, dinner, connect with them and build those relationships. But you have to have the understanding that those relationships are going to take time. They're going to take 2 to 5 years before they even invest a penny with you, even when it comes to family offices. But you have to stay consistent, and you have to build those relationships deep, and build that trustworthy with them. And that will help tremendously to partner with them on future deals.
Great. Anybody else has any questions? Please chime in. We still have 4 or 5 minutes more, I guess.
Are you doing any work with international investors, Chris? And I would love to understand the process. Are you taking money directly from out of the country, or are you setting stuff up here, funds, etc.? I'd love to hear a little bit more about that.
Yeah, great question. We have some international contacts, like in Singapore, Switzerland, Dubai. I have some family offices. We have not taken their capital just yet. We've talked about it with partnerships here. We would set it up as a fund here in the United States, and then have them invest into the fund itself. And depending on what state they're coming from, and how much capital they're bringing, we may have to set up an offshore account, which can be extremely costly. But we do have some Canadian investors that invest, and we have some partners in Canada that have expressed a lot of interest in investing in our next acquisition. So we're open to it. When it comes to the European market, we have not accepted anyone just yet. But we do everything here in the United States, and we'll roll out a fund so those investors can invest into it, because there's a lot of tax liabilities that are involved.
Right. So for your Canadian investors specifically, are they already have like ITINs, bank accounts, everything here in the U.S., or are they getting you the money directly from Canada?
No, they already have. They have LLCs set up, bank accounts. They're experienced and have done it before, but they have LLCs set up and bank accounts here in the United States.
Okay. Cool.
Yeah, it helps tremendously because of tax purposes. I don't want to be responsible for withholding tax, because if I'm $1 short or anything, I don't want that responsibility. So I want to make sure that responsibility is solely theirs. Just something when it comes to the auditing, something less that you have to worry about.
No, that's kind of the direction I'm headed to. Thanks.
Yeah, you're welcome, for sure.
Any more questions for Chris?
I know you've got time probably for one short answer, Chris. Do you miss South Florida?
Oh my goodness, I have family that's in town from South Florida right now at the moment. Sometimes I miss the weather. I do miss the food. I unfortunately, if you live down in South Florida, I know some people do. I love you guys. The people down there are totally different from Charlotte. But there's sometimes I do, sometimes I don't. But I don't miss it to where I want to move back. Now, I say that now, but for tax benefits, I may claim residency down there in the near future. But no, I love it here in Charlotte. You get to experience all the different type of seasons. You're here in the middle of the East Coast, so it's nice for travel, wonderful food, wonderful people, and it's a great real estate market.
And what town did you live in?
Lived in Fort Lauderdale. I have family in Delray, Wellington, and Coral Springs area. I lived in Delray for less than a year, but I was born in Fort Lauderdale, and then I moved to Orlando, lived outside of Orlando's MSA for around 5 years, and then moved up to Charlotte.
Great. Let me check on the social media if you have any questions there.
Yeah.
Actually, we do not have any more questions. Do we have any more questions here for Chris? Chris, I know you have to go, So, but thank you so much for
Yes, thank
joining
you for
us
having
today.
me.
And also tell us, how can people reach out to you if they want to connect with you?
Yeah, if you'd like to connect, go directly to our website, www.qccapitalgroup.com.
Thanks, Chris.